Joining us now to dive deeper into the numbers is Alex Grassino, Global Chief Economist at Manulife Wealth and Asset Management. Alex, thanks very much for joining us.
Thanks for having me.
Pretty flat. No surprises in the numbers there.
No, I think if you look at the headline figure, up 0.3% month over month, no big surprise. One slight source of upside was the 0.2% month over month. Street had been expecting 0.3%, so a little bit better at the margin. But if you look at food CPI, that's actually up 0.7% month over month, which is a problem for people who look at it from the perspective of grocery prices going up. You see that every week.
Yeah, and a quick question, how reliable do you think are these December CPI figures given the, recent data disruptions that we had, the pause? We haven't really got data out of the US in September. So I don't know if it's the month over month or maybe people or investors are going to be looking more at the year over year data to be more relevant. What are your thoughts on that?
Sure. I think it's a great point. We've gone from the delayed to the distorted data. We're still dealing with partial information at this stage, and we're running off of distorted months. So you take the data with a grain of salt and you look forward a couple more months before you actually feel like you get a clean read off of the CPI at this point. And we're really looking at the month over month prints right now just to get an impulse of where inflation is going at the margin.
Does it give you enough to kind of make an analysis of it and say, it is heading in the right direction or it's heading in the wrong direction with those numbers?
We still very much think that inflation becomes less of an issue as the year goes on. There's probably a couple of months where you see it pick up in the spring before cooling off. But one of the more interesting points really is that housing inflation seems to be well contained at this stage. A lot of the anecdotal evidence we're getting as well with rents across the country seems to be cooling as well. So if that moves down, it's a pretty powerful disinflationary force, which means that the data should be reasonably well contained.
Yeah, Alex, and I know you just mentioned talking about the housing as part of inflation and CPI figures. Is there any other sectors or stickiness in prices, broad base or concentration within CPI or key sectors driving the inflation rate this month or that you have any concerns over?
I haven't looked at the details just yet, but the general area that really does stand out is food. If that keeps climbing, it might not necessarily show up in the core metrics that you tend to associate with monetary policy, but the consumer certainly feels it because when you look at gas and energy, it's stripped up because it's volatile, but it is also the thing that a consumer sees every single week when they pay for groceries, when they pay for gas. So that would contribute to consumer anxiety.
And is that tariffs that are driving that? What's driving the food inflation?
There could be that to some extent, but it's just been an ongoing problem since the pandemic.
And showing no signs of letting up. Is the trend going either direction?
It's hard to say at this point, but we would hope to see it at least level off at some point fairly soon. You've heard the anecdotal evidence over the last several years. It was eggs, now it's beef. We'll see where it goes from here, but it's about digging into the components at this point and seeing if there's relief at this stage. One other thing that's important to note, though, is that while this number does help give you data, it won't really affect what the U.S. Federal Reserve does in late January. I think that when you look at key members of the FOMC, most notably New York President Williams yesterday, it seems like they're pretty happy to put things on pause, which means you get at least a couple more prints before you make a decision for March.
Can you see them kind of sitting pat until the handing off of power?
We do think that there's one more cut between now and late May. We think that the overall data is generally moving in the right direction to allow it. But again, it is month by month. And certainly having a couple of months of distorted data throws a monkey wrench into a clean read.
Yeah, and I think for investors right now, and obviously you know that as well, Alex, that the data can change and it is data dependent on how the economy does. And we get this backed up data to continue to see the month over month inflation CPI figures. I think there's about a 35% chance now that there's going to be a rate cut out of the U.S. I'm in alignment with you that, they might be pushed till the second half of the year a little bit more. We still expect cuts out of the U.S. And I think that should be positive for the U.S. stock market and the U.S. economy. Is there any other additional leading indicators that would suggest inflation could potentially reaccelerate in the U.S.? Or are we going to continue to project that data continue to come down closer to that 2% Fed target that they do have?
The way we're thinking about it really is that if inflation shows up in the tariff-affected areas, the Fed's effectively given those components permission to run hot, treating it as a one-off shock. We'd be much more focused on what services inflation does, because that's a proxy for wage growth, and that runs into medium-term inflation expectations. The thing is, though, when you look at the labor market, there's no real evidence you're going to see sustained pressure on wages at this stage. So if the labor market starts to tighten more, that would be something we'd be concerned about, but we're a long ways from that at this point.
I just want to get in one question about vehicles. There's some interesting numbers on that, apparently.
Hang on, I haven't had a chance to look at it just yet.
I haven't either, so I'm putting you. From me being on the spot, I get to put you on the spot, Alex. Sorry about that.
Let me see if I can look at it very quickly.
1.1%. Okay, I'm just getting the numbers now. 1.1% decrease for used trucks and vehicles.
Okay.
And new vehicles were flat.
Yeah, I mean, I think that's an interesting dynamic. When you look at where vehicles have been in the United States, you're actually seeing reasonable sales for autos and cars. Looking back to earlier this month when you saw awards vehicle sales come out a little bit ahead of expectations. It's clearly a chunky part of the consumer basket. But if you look at used cars and trucks down 1.1%, I view that as being possibly a distortion given where prior months were.
Okay.
So it could just be some give up. Wait a month to see. Standard maxim in economics. 1 month does not a trend make. You have to wait 2 or 3 before you get a real read off of that.
All right, we got to wrap it up there, and thank you for finding the answer for that. We appreciate your patience on it. Alex Grassino, Global Chief Economist at Manulife Wealth and Asset Management.